a simple guide to call options buying. Let's dive in. So hey guys, Steven here. I've been shooting a bunch of videos on the channel recently, specifically talking about edge in the market, right? There really isn't any edge that I'm aware of in stocks, Forex, or futures, but there is a clear and definite mathematical edge with options, with the edge being available to options sellers more often than to options buyers. Now, that doesn't mean you should just go out there and only sell options. There is much more that goes into it. However, from like the 10,000 foot view looking down, more often you will see the edge being in the favor of the option seller as opposed to the option buyer. Now, if you don't know who I am, I've made over 7 figures trading for myself. Here's a screenshot of my account a couple of days ago. I've been really consistent in bull markets, bear markets, sideways markets. I've taught over 6,000 traders how to be much more consistent themselves. Gary won 13 out of his first 15 trades. Howard, look at that equity curve. Aaron, in his first 11 days, made over $32,000. So obviously that's pretty good. And the way we were able to do that, the way I was able to have a 6-figure month recently, the way Gary and Howard and Aaron were able to have such high levels of success is very simple. Your goal as a trader should be this and basically nothing else until you get this. Find a strategy that has a clear, measurable, and mathematical edge and just do that. I'm going to repeat that again because it is that important. Find a strategy that has a clear, measurable, and mathematical edge, and just do that. Now, finding an edge and understanding what the edge is and why it exists, that can definitely get a little bit technical. But from an analogy perspective, there's nothing clearer than the blackjack example. And there's nothing clearer. When you play blackjack as the player or gambler, outside of you getting blackjack, you win whatever amount you bet. So for example, if you bet $5 on a hand of blackjack and you win without getting blackjack, you're paid the amount you bet, or in this case, $5. It's 1-to-1. You bet $5 and win without getting blackjack, you make $5. You bet $50 without getting blackjack and you win, you make $50. Now, here's the deal. By being paid what you bet, there is an assumption that you will win 50% of the time. Again, you're paid 1-to-1. You bet $26. You make $26 if you win the hand and do not get blackjack. So that if you are paid 1-to-1, there is a probability, or there is supposed to be a probability that you win 50% of the time. But because you go first, you can bust first or lose the hand before the dealer even has the opportunity to play their hand, regardless of the outcome they would eventually have. Now, by you going first and having the ability to lose your hand before the dealer even has the ability to play their hand, this gives the house a mathematical advantage or edge of 0.43%. So that is not a very big edge. That's pretty small. That's less than half of 1%. If you're somebody who's played blackjack and you're up money, you just haven't played enough hands. And my guess is the majority of folks who are watching this video who have played blackjack are down much worse than this edge because, well, you're probably a degenerate gambler. Anyway, remember, they pay you 1-to-1 as if you're supposed to win 50% of the time, but you really win something like 100 minus the edge, or 49.785% of the time. This creates a mathematical edge for the house, and is also why casinos win and you lose. And again, if you haven't lost in a casino, it's just because you have not played enough hands. So the goal is, let me scroll down here. The goal is, as a trader, to become the casino or the house. Get one of these edges on your side and keep dealing the cards because the result is inevitable, right? What is the goal of the casino? It's not to deal the cards better. It's not to make you have bigger bets. The goal of the casino is to deal more hands. The reason why the goal of the casino is to deal more hands is because with this edge, the result is inevitable the more hands that they deal, right? It can be, if you want it to be, the same thing in trading. get one of these strategies where you have an edge and just keep doing that. Keep trading the exact same thing, and over time, the result should basically become inevitable if you're doing it right. Now, as a reminder, and this is really important for everyone to digest and understand, if the strategy you are using or thinking about using does not have a real mathematical edge, the edge is against you. You can take that to the bank 100%. So if there's a strategy that you are thinking about doing, you're contemplating doing it, maybe you're talking about it with your friends, maybe somebody told it to you, maybe they sent you a different YouTube video, and you don't know the numbers around it that show you have an edge, it's against you. Right? Now, some of you, when you hear that, you might be recognizing or realizing why you've been so unsuccessful for so long when it comes to trading. Because if you don't know the edge in what you have, if it's not very clear in what the edge is on what you have and the numbers behind it, well, you've just been trading this whole time with an edge against you. That's all. And again, it's not a huge overhaul to flip the script and have the edge in your favor. But again, one of the reasons why you watching this video, who's probably been very inconsistent and really at least hasn't made the money you're looking to make when it comes to trading, it is mostly because there's a phantom edge against you in the market and you just don't know how to get it into your favor. Don't worry about that. That's why we're here. Now, when it comes to options sellers have the mathematical edge in their favor more often than options buyers. Now, that doesn't mean you just go out there and sell options willy-nilly. There is more to it. But again, from the 10,000-foot view looking down, the edge is in the corner or in the favor of the seller more often than it is in the buyer. Now, there's a number of reasons why this is the case. There's like 10 or so. But the one we're going to talk about today is called theta decay. Right? Theta decay, in short, is the rate of which the value of the option loses money. Every option on planet Earth at all times has theta decaying against it. So if you have an option that say is worth $5, there is theta decay reducing the value of that option every single day. So even in the instances where an option goes from $5 to $10 one day, without theta, if we removed theta decay from that equation, in most cases, that option would have been worth more than $10, right? So let me say that again without fumbling my words. If there's an option that is worth $5 and the next day it's worth 10, if we removed theta decay from that equation, that option would have been worth more than $10 on that given day. So theta decay is reducing the value of the option every single second, basically, that the option is out there in the ether and is yet to expire. So it's pretty simple. When you buy an option, you want it to go up in value. And one of the reasons why options sellers have an edge in their favor more often than options buyers is because something that is guaranteed to reduce the value of an option, theta decay, is always working against the price of an option. When you buy an option, you hope it goes up in value, assuming you want to make money. If you sell an option, you hope it goes down in value, assuming you want to make money. So you have this thing in the background called theta decay that is helping the option seller every single day. And it's one of the reasons, again, there's a lot of different reasons why the edge is more often in the favor of the option seller compared to the buyer. But again, as a blanket statement, when you have something that is a negative drag against the value of something, being a seller, you have a mathematical edge there. So really, to recap everything, theta decay is the negative drag against the value of the options. One of the reasons why an option seller has the edge in the favor more often than the options buyer is because theta decay is a thing and it is reducing the value of the option every single day. That is a very basic example and a pretty small example, candidly, of edge in the market. Remember, when it comes to blackjack, they have a mathematical edge. All they care about is dealing more hands. When you have the edge in your favor as an options trader, whether you're a buyer or a seller, your goal is just do more of those trades, have that edge be realized, and carry on. So now that we know the reasons, and again, there's a lot more than just theta decay as to why option sellers have a mathematical edge more often than options buyers, but If we are an option buyer, because the title of this video was a simple guide to call options buying, if we are someone who wants to buy options, whether we think it's a good idea, whether we like to risk one to make potentially 10 times our money, whatever it is, how then, if we know theta decay is working against us at all times, how then just again from a high level looking down, how might we be able to get the edge in our favor, right? If it's working against us basically more times than not, because we have theta decay reducing the value of the option every single day, basically, how can we offset that? Right? How can we get theta? How can we get something working in our favor to offset that negative drag against the value of the thing we want to go up in value? It's actually really easy. Maybe not so much before you watch this video, but it's really easy when I go through it. Okay? We just need to offset theta decay. Right? So 10,000 foot view looking down. The value of an option is being reduced every second of every day. Now, it could be fractions of a penny. It's not many dollars, many cents. It could be 10 decimal points of a reduction in the value of the option every second of every day. But death and taxes, theta decay. It's there. So we need to be able to offset that at some level. Now, like I'm going to mention a number of times and already have during this video, there are absolutely more times when options buyers have the edge in their favor over sellers than just what I'm about to talk about here. But this is kind of the most obvious one and the easiest one to sniff out. So without getting overly technical, because this can get very, very technical about what I'm about to explain, I'll give you the answer. Right? There are two times when options buyers can offset theta decay and thus have the edge in their favor. Remember, theta decay is always reducing the value of an option. That obviously benefits the seller more than the buyer, right? That's very, very basic. We are looking to offset that theta decay. And there's two times we can do that. Number one, before a company reports their earnings. And number two, when options expire the same day, also known as 0 days to expiration or 0 DTE. Perfect. Why before earnings? Well, think about it this way. Heading into earnings, there is a known binary event, right? Publicly traded companies are very regulated. You will know weeks in advance the day of the week that a company is going to report earnings. You will know the time of the day it is going to report earnings. You are going to know what that company projected for the current quarter previously. You're going to know what Wall Street expects that company to do for earnings. It's very, very transparent on when these earning announcements are. The company will release earnings, and when that release happens, all the company's earnings and their projections become public information. So right now we're in the fourth quarter of the year. All you know from the company is what they told you during their Q3 earnings, which was what were their earnings in Q3 and what do they project moving forward. Right? Come January, we will get Q4 earnings announcements where you will know, here's how we did in the fourth quarter. Here's how the performance was compared to what we expected. And here's what we think is going to happen moving forward and how that compares to what we thought a couple months ago, how it was going to happen moving forward. And because of that, every pricing model of the stock changes in an instant based on that new information becoming publicly available. So what you'll notice is a company reports earnings at 4:01, the stock moves up and down like crazy. Apple and Nvidia, a couple snobs in the market, and I think Meta now report earnings at 4:30 in the afternoon. As soon as that number hits the wire, the algorithms take over and the stock moves up a lot, moves down a lot, or sometimes it doesn't even move, right? The reason is because once that data becomes transparent, once that data becomes publicly available, all the pricing models that everyone has for that stock, they can get changed because you can input new data there. So what we notice is because there is an event that is known, earnings, and because it has the potential to move markets very, very largely, the expectation for a larger move in the stock increases going into that earnings release. And because it is known that the new information has the potential to move this stock significantly, because the day before earnings, we're going based on guesses. When earnings happens, we're going based on facts. Right? We're going based on facts when the earnings comes out. So because everyone knows this is the case, the market begins to price in a larger potential move up to earnings day. In effect, the market increases the potential move on that earnings day. Right? So the normal way to look at a stock is kind of this. On a normal day in a stock, the market may project a 1% expected move. But on the day where the market knows the company will report earnings, it could project a 5 or 10% expected move or more. This is a chart of what is known as the expected move in Meta over the last year. These kind of circles right here that are a red dot stacked on top of a blue dot, right here, here, and here, those are Meta's earnings announcements. The blue line is the expected move. So what you notice is before the February earnings announcement, the blue line went up. Why? Because we knew that there was going to be an earnings announcement. We know there was potential for the stock to move quite a bit. Thus, we have to price in the potential for a bigger move. Same thing in their April one. Before the earnings, the expected move increased. Same thing in August. Before the earnings, the expected move increased. And then same thing in October, November. Before the earnings announcement, the expected move increased. Now, this is where the edge can be in the favor of the buyer. Going into an earnings announcement, options expected move increases is sometimes so large that it can offset theta decay, meaning going into earnings, the expected move increases so much that it neuters, it offsets theta decay, removing one of the ways option sellers have an edge. If it is removed from an option seller, it is given to the option buyer. So what does that mean? Remember, we have theta decay that is working in the background every single second of every single day, decreasing the value of an option, right? But going into an earnings announcement, the expectations for a large move sometimes increase so much that it is increasing the value of the option because the expectation for a larger move continues to increase going into earnings, this blue line right here, and that offsets the theta decay that is happening in the background, right? So if we're able to offset or neuter or overwhelm theta decay as an option buyer, then the edge is in our favor. So the first time there is a potential edge for options buyers is going into an earnings announcement, right? The second time there is potential for an option buyer to have an edge is 0 DTE. DTE stands for days till expiration. Every option at some point expires and ceases to exist, right? DTE is the days till that option expires. 0 DTE stands for options which expire today. Now, the reason why options that expire the same day can have an edge in favor of the buyer is because this is something known as gamma. Now, that is way too complex of a subject to talk about here, and it's not relevant to know what gamma actually is. But the short version is this. Every option that expires out of the money is worth nothing at expiration. If you own an option on the same day it expires, the rate of change of the potential value of the option is the highest it will ever be. This means you can have an option worth nothing, worth 0. Then the stock moves $1, and all of a sudden, the price of the option goes from nothing to $1 or $100 in notional value with a very nominal move in the stock. So this is really important to understand. Theta decay is the highest it will ever be at 0 days to expiration as well. However, the rate of change of the value of the option is in many cases so much greater than theta decay on the day an option expires, thus giving the option buyer an edge. The edge comes from the rate of change in the value of the option being much larger than the rate of decay for an option that is expiring on the same day. So, to kind of sum up everything that I talked about here, option sellers have the mathematical edge more frequently than options buyers do. There's like 10 different reasons why, but one of the reasons why is because of theta decay, which is reducing the value of the option every single second of every single day until it expires. So as an option buyer, if you want to offset that edge and get the edge in your favor, you have to offset it. When can we offset it? Going into earnings, as the expectations for an earnings announcement and a larger move increase, that increase is greater than the decrease coming from the theta decay. And the same thing is true at 0 days to expiration. Because the rate of change of an option is so great, 0 days to expiration, the rate of change is greater than the decay from theta decay. Thus, in both of these cases, you are offsetting at least theta decay and really giving yourself, as an option buyer, a chance to be able to have an edge in your favor. So thank you everyone for watching this video. I hope it was valuable. If you found it valuable, go ahead and give me a like. Go ahead and give me a thumbs up. Go ahead and subscribe to my channel. Click the bell so you can be notified every single time I shoot a new video. If you are interested in learning more about mathematical edges and how to get the edge on your favor, I have added a link to below this video in the description. If you click on that link, that's going to send you on over to our website. There's going to be a 10 or 15-minute video on that webpage explaining a little bit more about mathematical edges, and see if you're interested in learning more beyond that. But again, it's really simple. More often than not, the edge is in the favor of the option seller. One of the major reasons for that is because of theta decay. The good news is there are two very distinct moments in time when theta decay, for the most part, is offset by something else: going into earnings and 0 days to expiration. And if you do this as an option buyer, somebody who buy calls or buy puts, you're going to give yourself a much bigger advantage than you probably have right now. See you in the next video.